ECB set up this, this tool, the TPI, in order to compress spreads where it's warranted, but I'm not sure it's warranted in this case. And I think the ECB will have to use it. I'm just not sure they're willing to go big enough. So that will be a big test.
Right, because it's politics. It's not about the transmission protection instrument at the end of the day. Megan, does the ECB go 75 tomorrow?
So I'm leaning towards 75 basis points, but with very low levels of confidence. Given how weak the euro is and given how high inflation is, I think the ECB will go bold. But there is an issue in that, as rates get higher, money is being pulled out of bank deposits into bonds, and so that's sort of working against what the ECB is doing as well. So I think they'll go 75 basis points, but they may well go 50.
Sorry, do you think are they going to go 75 because they're worried about what happens if they don't go 75? If they went 50, what impact do you think that would have on the euro?
So I think if they went 50, that would push the euro down relative to the dollar, and that's a big reason why I'm moderately on the side of 75 basis points. I think 50 would be a disappointment for the markets. The market pricing right now moderately leans towards 75 basis points. So a 50 basis point hike would be a dovish surprise, a small dovish surprise, and that would cause the euro to go to tumble further, which means that the eurozone is importing even more inflation.
Well, Megan, if the ECB goes 75 tomorrow, what does the press conference look like? Is the press conference then more dovish, or do you think that we're going to see some double down here from the hawks?
I think we'll end up seeing a more dovish press conference, but what I'm really looking for is two things. Where Christine Lagarde sees the long-run rate relative to the neutral rate, so how much the ECB expects it's going to have to tighten and be in restrictive territory to bring inflation down. We don't really have any sense of that, and we may not get it given that Christine has been clear they're going meeting to meeting, so they're not looking too far ahead. And secondly, I'd be interested to see what their conversation is around quantitative tightening, because in the U.S., of course, we're well into that. But there's not much chatter about that in the Eurozone, and there is a question about whether they shouldn't be quantitative tightening, given that they've taken a hawkish bent, given that they're hiking rates so much and are vowing to really fight inflation as their top priority. Should they really be reinvesting everything? Maybe we'll get a hint of that tomorrow. We may have to wait a bit longer, though.
Megan, we are seeing a lot of policy coming out of London, out of Paris, out of Brussels, out of Berlin to try and control the energy price as we go into winter. If we get a cold winter, it's going to be really difficult here in Europe. The problem is that at the moment, there is very limited efforts to reduce demand. We heard Ursula von der Leyen speaking about this a little bit earlier on. The danger is that we spend a lot of money this winter, we use a lot of gas, and then we come out of this winter with even lower reserves. Is this going to be a one-year problem, do you think, or do you think this is going to be a multi-year problem? And can Europe continue to support its citizens in the way that it is right now if this is a multi-year problem?
Look, I think this will be a multi-year problem. Germany, for example, plans on freeing itself from Russian natural gas by the end of next year, or by the middle of next year, I think. And that will help, but of course they have to find natural gas from elsewhere if it's not coming from Russia. Just by way of example, to your point, Guy, I think what we need to see is demand really reduced, and we need to see a shift towards renewable energies. A lot of the money that's going to subsidizing energy costs this year hopefully in the future will be pivoted so that it's actually going to invest in renewables so that demand on fossil fuels broadly can fall. There is sort of this assumption that we can have the same standard of living. We as individuals won't have to make much of a sacrifice as part of the green transition. We'll just change the source of it. And I think that's fanciful. I think that's really unlikely. We are going to have to reduce demand. That won't happen as long as energy is being subsidized, to your point, Guy, but that's going to happen. The question is, what does it look like? Does it look like rationing and blackouts? That will cause factories to close, and that will have a huge impact on demand, or does it involve households, turning down their heat in the winter a couple of degrees, in which case that won't have a significant impact on demand? That's the question. So far, governments are sort of encouraging individuals to conserve energy, but that's all on a voluntary basis. I don't think that that's probably going to yield significant results.
Megan, thanks a lot. We really appreciate it. Megan Green, Brown University Senior Fellow and Kroll Global Chief Economist. Thank you very much. And this is definitely the conversation here at the Barclays Energy Conference, right? Europe needs natural gas. The U.S. has natural gas. We're going to take a look at how to get it to Europe, how American energy companies can help. More from my exclusive interview with the CEO of Kinder Morgan, Steve Keen. This is Bloomberg. As we've been talking about, Europe desperately needs natural gas if it's going to avoid a miserable winter. So the U.S. has it, but there are some real obstacles with getting it to Europe. To that point, I spoke with Steve Keen. He's the CEO of pipeline and energy storage company Kinder Morgan. Kinder Morgan is one of the largest energy infrastructure companies in North America, has about 83,000 miles of pipeline. Here's part of our conversation.
Expanding existing facilities or building some of the new ones. That happens on the Texas and Louisiana Gulf Coast primarily. That's where our energy network is the densest. And so for relatively capital efficient investments, we can add to the transport capacity that can serve that growing LNG and get it to Europe, get it to Asia, et cetera. Those are our customers. The LNG facilities and their shippers are our customers. And so we can do that in a capital efficient way, but also the permitting is easier to get done. done there. And that's a big obstacle in a lot of places, getting new pipelines built. Permitting is a big deal. Texas and Louisiana, it's not that it's easy, but it's easier, that's right, and it's more predictable.
And we really got to unlock the Marcellus and the Haynesville, really, because that's where so much of the gas is, right? What would it take to get that gas down to the Gulf Coast?
Yeah, two different stories there. So the Marcellus, a lot of so Pennsylvania and Ohio, a lot of the takeaway infrastructure has been built. There's one big pipeline, as you're probably aware, MVP, that's been controversial. That would be an outlet for that. But the relatively cost-effective expansions south to get to the Gulf Coast where it can turn into LNG, those have been done. It gets more expensive from here. Haynesville is a different story. Not that it can't happen in the Marcellus, but Haynesville is in Louisiana and East Texas today. It's a shorter build, it's less expensive, and as I said, easier to get things permitted and done. And so, as we look across the supply sources, what we see is 22, we're talking billions of cubic feet a day. Okay, think of the U.S. as 100 in total, including exports. So 10 coming from the Permian in growth between now and 2030, 10 coming from the Permian, 7 from the Haynesville, and 5 from the Marcellus, Utica, and Ohio and Pennsylvania. So those first two pieces, that's 17, that's Texas and Louisiana to Texas coast and Louisiana coast. And that can get done. We've got the ability to do that in the U.S.
Would Kinder Morgan do a greenfield pipeline to get gas out of the Permian?
Yeah, we've done 2 already,
right.
And now we're expanding one of the ones that we've done, and we're looking at an expansion of the second one. Our greenfield pipe proposal is probably pushed out to like the 2027 timeframe, and that's because we can do compression expansions on existing pipe, and so can some of our competitors. And so that pushes out a bit the need for an additional greenfield pipeline for a few years.
If the permitting was easier, for example, and we're like, go ahead, build something right now, build that greenfield pipeline right today, what would be the other issues in terms of costs and labor that you would come up against?
Yeah, there are supply chain issues. Things are getting more expensive, not cheaper. Generally, in the places I'm talking about, Texas and Louisiana, we can find the labor, we can find the contractors who are willing to do the work, and we just have to be more thoughtful about our procurement. We can get the steel in the pipe and get the pipe rolled get the steel rolled into pipe. We can get that done with the supply chain as it is today. Some of the equipment is more expensive, et cetera. So you just have to be really thoughtful about how you price it. Every time we look at a project.
How much more expensive would it cost you today than a year ago if you were building it today?
What was $2 billion might be another 20% on top of that. Yeah.
A lot.
Yeah.
Do you think it's going to be 20% next year too, or does the cost come down for you guys?
No, I think we've been able to manage and still generate some competition for upstream, providers of what we need. And there aren't a lot of new long-haul greenfield pipes getting built. Most of it is what I was talking about before, which is relatively, capital efficient investments in the existing grid. And so, I think we can still get it done without continuing to see the kind of escalation we've seen.
In terms of LNG specifically, you guys do have a facility at Elba Island LNG, right? And we've had Cheniere, you've had Venture Global, really successful in building out their existing LNG terminals. How can you do that with Elba?
Those are our customers, and we like having successful customers. And again, we will serve those customers for their transport needs as well as their customers. Elba, we have an existing relatively small facility there today. This is in Savannah, Georgia region, 2.5 million metric tons per annum. We are looking at studying, though. Studying, not announcing, another 3 to 5 million that we could do there. And so we're looking at that. But really, the bigger part of our business is serving other people who are building LNG facilities.
And if you decide, what would be the deciding factor to build that out?
Return. And getting comfortable with the build costs and things like that. So and return being a function of getting long-term contracted. We generally are not participating in the global energy commodity market. We avoid that risk and the reward right now, but we generally try to get it under long-term contract. So it's really about getting under long-term contract.
That was my conversation with Steve Keen, Kinder Morgan's CEO. And Guy, I went on to talk to him about what's happening over in Europe. And he said there have been some European companies that have signed long-term contracts for U.S. LNG, but it's a push and pull, right? There has to be the right price there to do that and the will to do that, and then you have to actually build it. So this is a very long process.
And that's the problem. we don't need it to be long. We need it to be really quick. We need it right now. And it's going to be interesting to see how long this crisis ultimately lasts. If you believe the Belgian Prime Minister, it's going to be a decade, then yeah, some of this stuff really adds up. If it's over in a couple of years, then maybe it doesn't. So I think the duration of the crisis, certainly from a European point of view and from the US side, is really important here, because gas prices just so volatile. In fact, energy prices, Alex, more broadly, incredibly volatile right now. I look at what's happening with Brent crude. 2 days, we're down by 6%. We are all over the map.
That's down 6% just after OPEC actually cut production. I mean, that doesn't really make any sense. So how do you invest if you're a CEO when you have that kind of volatility? So speaking of shameless tease, I'm going to have much more from the Barclays Energy Conference. So in the next hour, I'm going to speak to Alan Armstrong. He's CEO of Williams. That's another pipeline company here in the U.S. And at 12:30, I'm going to speak with Chevron CEO Mike Wirth. He is perfectly placed to talk about the volatility within the oil price and what he sees. Don't miss that. Don't miss those interviews. This is Bloomberg.
Thirty minutes to the end of the trading day here in Europe for stocks. We're down by around 0.5% The reason for that, we're seeing commodities under pressure. So the oil stocks in particular, but some of the miners as well, certainly acting as a big break on the market today. On the upside, the utilities are doing relatively well. We'll talk about that a lot in the next hour. Euro dollar actually in positive territory now, turning around 99.46 is where we're trading. Big move in UK 2 years as well. We're going to talk about all of this to Mike Bell. We're going to get his take on all of this. He's JP Morgan Asset Management's global market strategist. He's going to join us next. The European close is coming up. This is Bloomberg.
This is Bloomberg.
Wednesday, the 7th of September, European stocks are lower as commodities get crunched. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Whippy, bumpy session here in Europe. Let's talk about what it all means in terms of the numbers. Stock 600 is down today, down by around 0.6%. Most of that is coming out of London. It's a commodity story. We're seeing both the mining stocks and in particular the oil stocks down pretty hard. Oil is really rolling over today. We'll get Abigail to take a look at what's happening with the oil markets in just a moment. Utilities are having a fairly good day. We'll dig into the details of why in just a moment with Rachel Morrison. The dollar is under a little bit of pressure now, actually turning things around over the last hour after surging to fresh record highs. We've got a spot 99.48 going into the ECB tomorrow. The euro a little stronger now. The UK two-year yield as well. We're seeing certainly a bid coming back into the bond market at the front end. 20 basis points. Earlier it was 31, I think. We were down by this as we see the ongoing announcements surrounding what is happening with the energy story here in Europe. We've got some of the announcements coming through, or some of the commentary coming through from the Bank of England a little bit earlier on. People like Hugh Pill, the governor speaking, Tenreo speaking, Catherine Mann speaking earlier to MPs. All of that having a big impact at the front end of the curve. The question is, well, we're seeing this big move at the front end of the curve. Is that basically signaling that we're basically just pushing inflation out, that all of this action that we're taking to protect consumers this winter and businesses is basically going to make the inflation problem a bigger, longer problem ultimately, and that is certainly something that's going to keep rates higher. That is the thing that the bond market is trying to figure out here in the UK right now. But there's a lot going on. Energy certainly front and centre. Abigail Doolittle, what's happening with US markets?
Well, you know, Guy, it's pretty interesting because today we do have solid gains for equities, which not a lot of chop at least yet. You have the S&P 500 and the NASDAQ both up more than 0.4%. The S&P 500 leading the way, which points to a broad-based rally for that index. The last time I looked, all sectors higher except for energy, and we'll be taking a look at energy, oil in one moment. But first, take a look at this dollar-yen, Guy. It's really amazing. Right now, up 1.2%. On the year, up 25%. That, of course, tells us that the yen is down 25% on the year against the dollar. It's worst year ever. And, of course, there's some idea that maybe the BOJ is going to intervene. But so far, they are standing pat, but lots of pressure on that central bank to join other central banks and hike as opposed to remaining loose. If this yen continues to slide, maybe that will happen. And then finally, oil below $85 for the first time since January. A combination of that strong dollar plus demand. Still this question about whether or not a recession is on the way, and is there some sort of demand destruction, especially relative to China, given the fact that there are still the COVID-0 lockdowns in place, Guy.
Absolutely. What happens if that changes? What does that do to demand? Abigail, thank you very much indeed. Alex has left the office. She has travelled a few blocks. She is now live at the Barclays Energy Conference. She is very excited. So what is the takeaway? You've been talking to a bunch of people so far. Energy is at the heart of just about everything right now. What are you hearing?
I'm hearing that Europe is in a really tough spot, that there are no easy solutions. Yeah. Everyone can pretty much agree that you probably don't want to be taxing energy companies right now and you want to incentivize investing, but of course they're going to say that. But it's all about how do you wind up getting exposure to the international LNG market, which is really a story about Europe and how to play the crisis that's sort of developing there.
Yeah, it continues to develop. It appears to be getting worse, and it's going to be interesting to see ultimately how it turns out. We don't know whether or not, Alex, this is going to be a one-year story, two-year story, three-year story, 10-year story. I think that's one of the problems that we're really facing here as well. We've got a whole load of news that has come out today. And I think we kind of need to sift through it to try and understand exactly what is happening. You've had news obviously out of the UK relating to what is happening with the energy cap here. We're going to get more on that tomorrow. We've heard Ursula von der Leyen speaking a little bit earlier on. She's coming out with a whole load of measures. Basically, she's going to cap energy costs for non-gas producers at around 200 megawatts an hour. That's going to get fed back into the consumer. We've got liquidity support coming through from companies. We've also had commentary today from Vladimir Putin as well, talking about what he's going to cut off. So we're in real flux here once again, and trying to understand exactly what is happening is really important, because it's going to have a massive impact, for instance, into what is happening tomorrow with the ECB. So let's talk about all of this now in a little bit more detail. Remember, we've got this big meeting coming up on Friday, which is really going to bring all this together, try and coalesce all of the plans that are being put in place right now. So the person here at Bloomberg whose job it is to sort of pull it all together, to understand it, to give us all the skinny on what really is going on is Rachel Morrison. So kindly, she joins us here on set, because she's quite busy right now. Can you pull it all? What have we learned today?
Well, what we've heard today is the main news really is what the Commission proposals hold, as you outlined, what the Commission wants energy ministers to discuss on Friday. And at that point, we'll hear what different countries want. We'll get a bit more of a handle on what's realistic, what has to be watered down, and what can be brought forward. So the important things are, as you mentioned, the cap on non-gas fired generation, so that's renewables, nuclear, coal, and that we think is at around €200. And the reason that utilities kind of stocks reacted well to that was that's higher than a lot of people were expecting or fearing. And also we've heard some opinions that that's still okay for investment. That will, as Alex pointed out, that will still mean that those renewable investments get made. But on the other hand, there's possibly going to be a cap on Russian gas, and that's where Putin has come out and said, anybody who does that will not receive any supplies of any Russian energy, which, could be problematic.
Which is basically the tit for tat that we saw on Friday with the oil price cap, and then of course Nord Stream 1 not reopening. Rachel, there was also talk from Ursula von der Leyen of a solidarity contribution from fossil fuel companies. I talked to Ryan Lance about that. What is that? What does that mean?
I think a lot of what the language around what's coming out of the EU is talking about ways of taking money in places where there are profits and moving it to where it's needed, and that is really consumers. So a lot of the sort of windfall tax and levy, a lot of that language is missing, but that's kind of what we can read into the intention, and also what really we can explain it as.
What are we expecting tomorrow in terms of Liz Truss's plan?
Liz Truss is supposed to be announcing energy measures. So we know she said yesterday that was, going to be the first thing she was going to tackle. And a lot of what we expect, we have perhaps seen, some of the action on bills to freeze the price cap, but really the details of how she's going to do that, and compared to what has been leaked, we'll have to see. But that kind of price freeze for the on the energy price cap is what we're expecting, and that's really the relief that households need in order to get through the winter.
Rachel, here at the conference, we're talking about the crisis, and it's a multi-year kind of thing. I mean, if someone's going to build a pipeline or an LNG export facility, that's a multi-decade kind of project. And I'm wondering, when you look at all these headlines, are leaders talking about this being a multi-year situation that they have to tackle? It does feel a little bit short-termism when it comes to, say, taxing or any kind of price cap or any kind of relief.
We're hearing the same as you. We've got some reporters on the ground in Milan at a gas conference who have been hearing the exact same thing, that really policymakers are focused on the short term, on this winter, and throwing money at that problem. And the industry, the market, is looking forward out to 2026 when LNG comes online, and saying it's going to be painful until then. And that's a pretty pessimistic outlook, but nonetheless, that is what the market is really focused on.
Rachel, thanks so much. It's a lot to parse through today. Rachel Morrison of Bloomberg, thank you very much. And coming up, speaking of, Ryan Lance, the chairman and CEO of ConocoPhillips, was just in Gastech in Milan. And he says if Europe wants to increase supply long term, imposing a windfall profits tax is exactly the wrong way to do it. My conversation with Ryan Lance is next. This is Bloomberg.
Certainly energy security has elevated its position, and certainly we're going through a transition. We have to do it more sustainably. And I think they're struggling with how to write the right policy to encourage early time investment, yet figure out how they want to go through the transition. And some of what they're talking about with excess profits tax, it's going to have the unintended consequence of reducing supply long term.
When U.S. jobs numbers are released,
Number that's pretty much in line with what Wall Street expected.
Bloomberg brings you crucial data at terminal speed.
315,000 jobs created, an optimistic number for the Federal Reserve.
And instant expert analysis.
Dare I say that this might be called a Goldilocks jobs report?
What this does is really push away a lot of the arch gloom.
Maybe leading us toward a soft landing.
The Fed is still going to be debating 50 or 75 basis points.
Nobody covers Jobs Day like Bloomberg, your global business authority.
Certainly energy security has elevated its position, and certainly we're going through a transition. We have to do it more sustainably. And I think they're struggling with how to write the right policy to encourage early time investment, yet figure out how they want to go through the transition. And some of what they're talking about with excess profits tax, it's going to have the unintended consequence of reducing supply long term. So I think they've really got to think through how they're going to manage their whole supply situation and what it means to eliminate, get off a Russian supply, both from the oil and the gas side. And it is a Gordian's knot. It is a really tough thing that they're going through. But the solution is not to tax what you want more of in the short term.
Right. That's going to deter maybe where you then put your money.
Yeah, you're going to put your money into other places, and supply is going to go down while demand is still out there.
That was Ryan Lance, ConocoPhillips Chairman and CEO, joining me from the Barclays Energy and Power Conference. And obviously, Guy, oil companies are going to say, please don't tax us. But I think the threat there is quite real. And then you add on the volatility that we've seen in the actual underlying commodity price, and it makes it very difficult to make longer-term investments.
It does. I don't think it's quite as simple and straightforward as some would like us to believe. If you look at what Europe's done today, I think it's quite interesting. They basically capped the price of electricity for non-gas producers. So if you're a solar producer, you are making a lot of money right now because the price you are getting paid for the electricity, the electrons that you're producing, is based on gas. Yet your costs have changed in no shape or form. So if we're going to go through an energy transition, do we need to cap that price? Maybe that's one way that it does work. How do you then recycle that money back into the system? I don't know. But it's a really fine balancing act. I don't think it's black or white. I think there's some shades of grey in the middle. This needs to be a managed process. And I think it's going to be really difficult for Europe to manage it.
Well, and also, I think to that point, someone has to pay for it. Megan Green was saying this in the previous hour, right? Somebody's going to have to pay for all of this because this is going to be a huge amount of investment that's going to have to take place. And that's going to have to be spread out among companies, among populations, among utility. You can't just say we want to do this and no one pay for it. The war with Russia, though, has just sort of brought this even more to the forefront and made it much more urgent. But this was a reckoning that was going to come and something that was already sort of rattling the oil industry to begin with.
Yeah, the hope was it was going to be feathered in, that it would be something that we could do relatively in a straightforward fashion. That now hasn't happened. But there's some really interesting pieces. There was a really interesting piece I read on the terminal first thing this morning talking about what is happening with solar here and how much solar is being built as a result of that, because the return time on some of these solar investments is coming in dramatically at the current prices that we're dealing with. And even at 200 megawatts an hour, you can still make investments and make money and get a decent rate of return and bring the turnaround time in really quite dramatically. The problem here is not actually going to be demand, it's going to be getting the available solar cells, a lot of which come out of China. So then you bring in the whole supply chain issue as well, which is another factor that's going to complicate matters too. So there's so much going on. It is by no means an easy solution to solve. But I think simply saying you can't tax us because otherwise we won't invest, I'm not sure that flies either.
Well, no, but I think that the point then also becomes, can they make the investments that they want to be making if there is uncertainty and regulatory uncertainty? And we'll talk about this later on in the show, but the biggest place you see this is in the pipeline and infrastructure industry. That's a very long lead time, and that's really where you see the problem, either if it's taxation or regulation and the lack of clarity that becomes the bigger issue.
Yeah, it's going to be with Europe for a long time. And the question, therefore, is what does that do to the investment case around Europe? Mike Bell, JP Morgan Asset Management Global Market Strategist, joining us on set. Mike, we seem to be dealing with this energy crisis as if it's going to be this winter, and then we're done with it. It's not going to be this winter. It's going to be a multi-year problem that Europe is going to have to navigate. How does that, now that that's becoming crystal clear, how does that change the investment case?
I mean, look, near term,
ultimately Europe's in significant trouble. It's going to put downward pressure on growth, and I don't really meet anyone nowadays who doesn't think Europe's heading for a recession. Question obviously is, how does it get out of that?
Yep.
And there are scenarios one can imagine in which the gas could start flowing again, but without that, it's going to be a very difficult ride.
So where does that, where does that leave Europe as an investment case? People joke about the amount of money that's leaving Europe right now.
Yeah.
What is it going to take to get that money to come back?
I think it's going to take a resolution to the problem with gas. I think ultimately we need the gas flowing again, because with the gas shut off from Russia, Europe struggles. Its businesses, particularly its businesses, but consumers as well, are in a very difficult position. So you need a resumption of gas flows, but obviously there are significant political hurdles in the way of that.
So, Mike, on a rudimentary basis, is that a short the euro, short European equities, short the bond market in Europe call? Is that how pessimistic we're getting here?
I mean, I do think there's potential further downside for European assets. They've obviously gone down. Euro stocks are down a fair amount year to date already. The euro's been very weak. But could there be further downside? Yeah, certainly. I think there could be. Broadly speaking, my philosophy is that it makes more sense to try and be overweight stocks on the way up and neutral on the way down, rather than outright going short or underweight on the way down. So I would still be neutral at the moment. But yeah, I think there is further downside potentially.
It is neutral. Am I in when I think about Europe, am I in preserving my money mode rather than making money mode? Is it a relative trade, i.e. you're going to see some stuff that really gets hammered here? If you want to own and be neutral European assets, am I still going to lose money on that neutral position?
I think in absolute terms, so if you're not thinking relative to a benchmark, in absolute terms, one can certainly picture a world where European stocks go lower. I think if we saw European stocks down 30% from their peak, I'd start to get interested.
Okay.
But we're not down that much yet.
So, Mike, does that mean that if you're not interested yet, are you sitting in cash, or are you putting money into other different kinds of assets?
Yeah, so I think, sort of benchmark relative portfolio, I personally think it makes sense to be sat neutral at the moment, just trying not to give up the alpha made on the way up. But, the obvious implication of that is that you might defend it in relative terms, but in absolute terms, the equity part of the portfolio is still vulnerable to further downside.
So a lot of people are in cash right now. Do they stay in cash? What does cash look like as an asset? Interest rates are going up. We could see 75 basis points from the ECB tomorrow. Does cash in Europe start to become a more attractive option here?
I mean, look, obviously real returns don't look very clever in cash terms, but inflation affects everything.
Yeah.
So if you've got cash and that's giving you a negative real yield, but you've got stocks, and then you've got to subtract inflation off of that, plus, maybe some further downside, then on a relative basis, owning some cash, I wouldn't say makes no sense at all. I actually think you look at European government bonds at the moment, and indeed treasuries, the market's pricing the ECB get rates to 2.2. If Europe goes into a recession, which is what pretty much everyone I speak to thinks now, then it seems unlikely the ECB are going to have rates at 2.2 for very long.
But you think they get there?
I'm personally not convinced they will get there, but if they do get there, I don't think they'll stay there very long.
What happens if inflation stays high in that environment?
I think ultimately, if you get a recession, if they allow unemployment to rise, then inflation won't stay high. Wage pressures will come down and inflation will dissipate. If you got a recession and they do another big furlough scheme and basically don't allow unemployment to rise, right? If every time there's a recession, governments stop the unemployment rate going up, then we're just going to keep on hitting this inflation problem. So ultimately, you need higher unemployment to get inflation down.
Mike, do you think there's a stomach for that?
Sorry, what was that?
Do you think there's stomach for that? Do you think the politicians have got the stomach for that?
I think the central banks do. I think in the US, I mean, you've heard from Powell and various members of the Fed that they want to do whatever it takes to get inflation under control, even if that leads to a hit to employment conditions. And I think in Europe, it may not even take much monetary policy tightening because the gas situation could tip them into recession.
Mike, great to catch up. Always a pleasure. Thank you very much indeed. Mike Bell of JP Morgan Asset Management, thank you very much indeed. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. United Parcel Service plans to hire more than 100,000 extra workers during the holiday season. That's similar to the number UPS hired the last 2 years. Online shopping has slowed after a pandemic-induced surge, but the figures are still well above pre-pandemic levels. And the Spanish oil and gas giant Repsol is making a dramatic shift away from fossil fuels. It's selling a quarter of its exploration and production division to U.S. private equity firm EIG Global Energy Partners. The price, $3.4 billion. Repsol is raising funds to help pay for low-emission projects whilst reducing its cost of capital. And in the UK, housing prices rebounded in August. They were led by the strongest growth in London in 6 years, according to mortgage lender Halifax. Property prices rose 0.4%. The average cost of a home in Britain, a record $338,000. And it is a victory for shareholders of Swiss luxury brand Richemont. They rejected Bluebell Capital's proposal to add the former head of Bulgari, Francesco Trapani, to the company's board. Instead, Richemont named an existing board member to be a shareholder representative. And that is your latest Business Flash. Guy.
Ritika, thank you very much indeed. Let's talk about what's happening with European markets. We're coming into the close. Commodities are under a little bit of pressure here, folks. So the mining stocks are down. The energy story absolutely front and center. Brent crude is down circa 6% over the last couple of days. That is probably good news from an inflation point of view, but it's certainly hitting the London market fairly hard today. So the London market underperforming. We're down by around 0.6%. I don't think it's got anything to do with Liz Truss. It's got nothing to do with what is happening elsewhere. This is purely what is happening in the commodity market, dragging the situation down. So London is down by around 0.6%. So the other end of the spectrum, you've got this kind of big utility story, which has largely come out of Brussels today. Ursula von der Leyen speaking earlier, talking about this 200 megawatt cap that we're going to be putting on utilities, non-gas utilities producing electricity. That is way higher than the market has anticipated. So you're seeing a whole range of names, Energy, Drax, RWE, all these names having an absolutely cracking day. I'll deal with the details of that in just a moment, but the DAX is up by around 0.5%. The CAC 40 is up by around 0.2%. The European close is coming up next. next, mixed day, I guess you could say, for European equities. Details to follow. Close is coming up. This is Bloomberg. So when it comes to European bourses, if you've got a lot of utilities, you're having an okay day. If you've got a lot of oil stocks and mining stocks, a little less so. And you can see that quite clearly. The DAX up by around 0.5%. You've got the FTSE 100 down by around 0.5%. And basically the reason is London's got a lot of commodity stocks. Jurassic Park certainly suffering today. So that's the kind of the big picture right now. Let's break it down and take a look at what the sessions look like, because that is deeply uninspiring. To be honest, we've gone sideways in a very big way. We're trading 412. We're down by around 0.4%. There's no clear sense of direction here. The story is very much at a sector level. So let's break it down from that point of view and give you an idea of what's happening there. So you've got at the top, utilities up by 2.26%. Huge day for utilities. Bit of an underperformance recently. And what we've seen here today is Ursula von der Leyen coming out with this plan saying we're going to limit non-gas producers to 200 megawatts an hour. That is way higher than the market was anticipating. And the market, to be honest, wasn't really pricing in the super high prices that we've got right now. But we've now got a little bit of clarity, which is allowing the market to maybe price this story a little bit better. I'll show you some of the individual names in just a moment, but that sector doing relatively well today. There's only a handful of sectors in positive territory. Down there at the bottom, Energy's down by 2.83%. As I say, Brent crude down by circa 6% over the last couple of sessions. We've just got some news. Chengdu, the Chinese city, southern Chinese city, circa 20 million people, extending its lockdown. So that's another demand hit. And that's why OPEC is worried right now. That is what is happening here. And oil's certainly rolling over. Let's talk about some of these utilities. Drax Group, out of the UK, up by 6.29%. RWE, the huge German heavyweight utility, up by 8%. That's why Germany's outperforming. The French stock, Energy, up by 4.75%. Energy is absolutely front and centre. The utilities today getting a little bit of clarity and the market reacting very positively, Alex.
Yeah, so let's stay with Europe's energy crisis for a moment. So this time let's take a lens to the UK. Prime Minister Liz Truss saying today that she would set out her plan on Thursday to help UK households and businesses facing soaring electricity and energy bills. In her first Prime Minister's question session in Parliament since formally taking office yesterday, she took a strong stance on windfall taxes.
A windfall tax. I believe it is the wrong thing to be putting companies off investing in the United Kingdom just when we need to be growing the economy.
Joining us now from more is Bloomberg's Lizzie Burden. She joins us. Hey, Lizzie, what will the new Prime Minister do tomorrow? Is the plan supposed to be announced? What can we concretely expect?
So documents seen by Bloomberg suggest that Truss is going to unveil an energy bailout to the tune of up to £200 billion, and this will be support for consumers and businesses to help them with their energy bills through the winter, because of course for consumers at least they were set to rise by 80% next month. So what we're wondering is, how is she going to fund it? You heard that clip of her at her first Prime Minister's questions there. The opposition leader Keir Starmer went in with his first question about the windfall tax, and there had been this Bloomberg scoop by my colleague Alex Wickham revealing Treasury analysis that showed that if the current windfall tax were continued, because of the excess profits of energy companies, it would rake in tens of billions of pounds for the Treasury that could be used to help people through the cost of living crisis. So I suppose Starmer was asking, would you use that money to fund this energy support? And it sounded as though Truss was saying no, she wouldn't. But then we now understand that she will continue the windfall tax. So it would now seem, it's a bit of a head scratcher, that perhaps what she means by not using a windfall tax is that she's not going to increase or extend it to power generators. But these are the details that we hope to find out tomorrow.
Details, Lizzie. So far, I have almost no details from number 10 Downing Street since Liz Truss has occupied it. Are we going to move from vague to details over the rest of this week? Because we now need details. She can't continue to be this vague. Are we going to get them, do you think?
We do need detail. I was there, we listened to her acceptance speech when she won the leadership, scant on detail. I was there in Downing Street when she made her first speech as Prime Minister. Again, scant on detail. The market is craving it, and all the people who are facing higher energy bills this winter, who are going to be voting in a 2024 general election, are craving that detail. The reason that the markets are craving it is because it completely changes the outcome for the Bank of England and the future path for interest rates. Bloomberg Economics analysis suggests that if this energy package is what we think it's going to be after all the leaks, then inflation would be arrested at its current rate. It would have peaked already. A recession would be avoided, although Andrew Bailey, the BOE governor at the Treasury Select Committee today, said it wouldn't. And our economists say that the economy might be at risk of overheating, so it means that interest rates would stay higher for longer. And Hugh Pill, the chief economist of the Bank of England, seemed to support that view as well at the Treasury Select Committee today, because he made the distinction between short-term inflation, which he said would fall because of this package, and longer-term inflation, so seemingly agreeing with our economists' outlook.
Lizzie, to that point, how united is the government going to be on whatever plan that Liz Truss unveils tomorrow? It's obviously going to be needed. Any details will be happily absorbed. What's going to be the unity in the government?
Well, it's not just the government to think about, because Truss has appointed mostly loyalists to her government. She's rewarding the loyalty that got her to number 10. She backed Johnson all the way. But within the party, there are big divisions that are yet to publicly open. Remember, Rishi Sunak and his allies are on the back benches. And, the markets still need reassurance about all this. And it's not just how to fund the energy package. It's also what she said about the Bank of England, Brexit. But in terms of how to fund this package, we also heard from Andrew Bailey at the Treasury Select Committee talking about potentially putting the brakes on the quantitative tightening programme, because if they're going to have to fund so much, if so much borrowing is going to happen, then perhaps it's not the time to be starting active gilt sales, because we'll be pulling in opposite directions.
Yep. Talking with the Bank of England, at least Kwasi Kwarteng today was talking about the fact that independence is sacrosanct, so the market breathing a sigh of relief, I think, there. Lizzie, great stuff as ever. Thank you for the analysis. Bloomberg's Lizzie Burden. Let's talk about where European markets have finished. We are through the auction. Yep, just checking the time. Let's see what exactly we are looking like as we come through the close. A little bit of dip by the looks of things for the FTSE 100 coming through the end of the day. We have certainly seen energy prices a factor in terms of what we've seen with those energy stocks and those commodity stocks. Yeah, a little dip lower. The FTSE finishing down by 0.9%. DAX in positive territory. CAC finishing flat. I'll be doing a lot more analysis on all of this at 5 p.m. alongside Kriti Gupta. We'll be taking you through the cable. That's 5 p.m. London, 12 p.m. in New York. We're on DAB Digital Radio, and you can find the podcast later if you miss us. Spotify and iTunes is where you'll find us. Talking of which, let's get back to Alex. What are we expecting coming up from your conference?
Right, so that's why I'm not with Guy, but I will listen to that podcast. So we'll be in the winter heating season before long. Winter's coming, then summer's coming. The U.S. has the gas that Europe needs. That's the real conversation here at this conference. Alan Armstrong is Williams' president and CEO. We're going to talk about how to get that gas across the Atlantic. He's one of the biggest pipeline operators in the U.S. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Russia's President Vladimir Putin blames Western nations for the shutdown of the Nord Stream natural gas pipeline. Putin told a forum in Vladivostok that gas flows to Europe could resume as soon as sanctions are lifted and Russia can get the pipeline's turbines serviced. He said, quote, "Give us turbines and we'll turn on Nord Stream tomorrow." The head of NATO says the war in Ukraine is entering a, quote, critical phase. Jens Stoltenberg told the Financial Times there could be a tough winter ahead for members of the military alliance, and that could include energy cuts, disruptions, and possibly civil unrest. He said households and businesses will be tested as they face soaring energy prices and the rising costs of living caused by Russia's invasion. And a warning from JP Morgan Chase, the cost of living crisis in the UK has only just begun. Retail analysts at the bank say consumer spending on discretionary items may shrink by a mid-single-digit percentage next year. That's even if the UK energy price cap is frozen. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Appreciate that. So the story we've been talking about all day is that Europe needs the gas, the U.S. has the gas, and one big problem to getting our gas across the Atlantic is really infrastructure, whether you're looking at pipelines or export terminals. Now, one company in the thick of it is Williams. It transports about 30% of U.S. gas all around the country, and CEO Alan Armstrong joins me now from the Barclays CEO Energy and Power Conference in New York City. Alan, good to see you. Thanks for joining.
Thank you. Glad to be here.
The one help we have right now in terms of building out pipelines is the Inflation Reduction Act and trying to streamline and make permitting process easier. Is it going to work?
Well, I would say, we were all hopeful that the two things would be tied together when that was in progress, and we're very hopeful for that.